big difference between government and private. I'm assuming that over the next few months, we're going to have to start stripping out the government component of this as the census numbers go higher. I'm assuming that they're going to rise sharply and then kind of crest and then kind of fall fairly sharply. How difficult is that going to make kind of understanding what we're really seeing in the U.S. economy?
Well, yes, to your point, we should have census hiring. We actually expected some this report, but it's actually relatively easy to strip out. And how we do it is we just look at private payrolls. Just one other comment on government. We actually have seen local government hiring pick up, but that tends to lag the broader economy as you have tax return, tax income for local governments rise, which tends to lag. But that's why we're going to be focused on private payrolls, because that'll be a better indicator.
Tiffany, it seems like trade is the wild card here, right? And even earlier with Larry Kudlow, we saw him pivoting a little bit from China and towards Europe when it comes to talking tariffs. How much do you anticipate tariffs will hurt the U.S. economy in the coming months?
Well, I think, certainly uncertainty around what's going to happen with trade policy is just something that's just kind of a cloud that's hanging over the U.S. economy. But the other point that and that's resulting in a pullback on CapEx and things like that. But the other point that I would just make is that the threat of trade tariffs is actually already disrupting U.S. economic activity. And we think that you've seen some pull forward of activity to try to get that imported, produced, and stocked ahead of tariffs. So rather than tariffs actually go up or not, later next week in October or in December, might not really matter because we already saw that boost of activity. So we could see an offsetting decline in activity after that, regardless if they go in or not.
Tiffany, final quick question. Does the bull steepener continue?
Well, I think certainly the market is pricing in more Fed accommodation because there's indications that the economy is slowing and will continue to slow. Now we're expecting the economy to slow to 1% growth early next year. And this is what we're calling a window of weakness because we're not sure if it's a window into recovery or recession. And certainly if it's into recession, then you would expect the Federal Reserve to cut much more dramatically. And that does tend to steepen the interest rate curve.